Hello and welcome to Pro Trader Strategies Market Commentary for Monday, November the 23rd. I'm Eric Wilkinson, and you very well may recognize me as the Wolfman from mainstream media, where I've talked about the economic data, the geopolitical environment, and how that comes in to impact the markets with some of my market analysis. And I do the same thing for you folks out there, but I go a little bit further in these daily market commentaries and talk about option strategies. Also, what we've done here at Pro Trader Strategies is streamline that process in order for you guys to follow certain guidelines to find the right or the most appropriate option strategy for any given assumption. We're not just picking option strategies out of the hat. We are following a guideline that will lead us to the most profitable or the most probable option strategy of success. All right, so that's the best way to increase the overall yield in your portfolio. All right, so without further ado, let's get on with it. Economic data this week is important in terms of all of the economic data we're going to be getting. And usually on a Monday, it's pretty quiet, right? Well, not today. Today we've got over across the pond some pretty major economic data points that we look at because they are forward looking. Remember, these are PMI, Purchasing Managers Index. Across the pond, their most important data point for Purchasing Managers Index, the PMI, is the flash estimates. We get our own flash estimates here in the United States, but we really look to the ISM, which is the Institute for Supply Management, Manufacturing and Services, PMI. That comes out next week. We usually get this one a little bit early, which is still a good indication as to what we're going to be seeing in the ISM. So we'll take a look at that there as well. All right, so across the pond, France comes in with their services PMI. Anything above 50 expansion, anything below 50 on all of the PMI numbers is contraction. Expansion above 50, contraction below 50. And we also get the breakdown across the pond. Europe, manufacturing sectors are France and Germany. So keep your eyes out for that. Those are going to be the ones that people really hone in on. So France, services PMI coming in at 38.0, expected to be 39. Remember, anything below 50 is contraction. That's in the 30s. We are well below looking at getting into positive territory there on the services sector. But the French manufacturing PMI came in just below that watermark at 49.1, expected though to be above 50. Now remember, last month's number did come in above 50. It's been back and forth for the last several months, but we did have 2 months in a row of positive PMI there for the manufacturing sector, snapping that streak and going below 50 this month. All right, Germany. Manufacturing PMI coming in at 57.9, better than the expected 56.0. So nice to see that again above 50 with Germany. That's happened about, this is the third time, or actually fourth time in a row we've gotten back above 50. So that's a good thing there. And then we look at the Germany services PMI coming in at 46.2, again, a below 50 reading, but in line with expectations. They did revise last month's number up from 48.9 to 49.5, so just slightly coming in lower. We've had 3 months in a row where that's been below 50. It's pretty much been below 50 since COVID started, though you can rest assured there. All right, Great Britain. We're looking at Great Britain's manufacturing PMI coming in at 55.2, expected to be 55.5, so solidly above 50 again this month. Slight revision upward from last month, which was 53, or came in at 53.7 on the revision. The Great Britain's services PMI coming in at 45.8, expected to be 43.2, so nice to see that coming in above 50. Now here back in the United States, we got our flash manufacturing PMIs, and that came in at 56.7, expected to be 52.5, and then the flash services PMI coming in at 57.7. Now keep in mind, this is a busy week for economic data. Tomorrow we get Richmond Fed manufacturing. We also get core, I believe we get PCE, which is personal consumption expenditures, new home sales, and personal income. So those are going to be really important here in the United States. Also durable goods. So a lot of things happening this week. Tomorrow probably one of the quieter days with only getting Richmond fed. Thursday being a holiday, and Friday we'll be back at it again. All right, so let's take a look at the overall markets and see how they're being impacted. We've got crude oil moving a little bit higher. Not super surprising here. We're seeing the manufacturing sector ramp up here in the United States and across the pond. Now, remember, I've been saying we start seeing a resurgence in manufacturing. That's going to drive some of this demand for crude oil as most of the distillates and oil go into manufacturing process, whether it's breaking it down for polypropylene and things of that nature. Manufacturing consumes a lot of crude oil or its byproducts when it's broken down. So we're seeing crude oil move a little bit higher. Gold falling on its face right now, as you can see here, with the markets completely trying to sell off here in gold right now on the day. You can see that the market is falling off. Now, this is with the equities hitting a low. Not equities, the dollar index hitting a 2.5-year low. Now, I've talked about this like I'm blue in the face. We start seeing a weakening dollar, we should see strength in gold futures. That's not happening right now, which is a little bit of a bizarre situation. We're seeing gold really sell off as the dollar is coming off, and this is dollar denominated. So this is something that is a little bit odd here. So it is something I'm keeping an eye on. It comes down and tests that 200-day simple moving average right here. That is going to be a spot. Sorry, I don't want that. All right, so if it comes down and tests this 200-day simple moving average, which is right here, that is where I am going to be taking a look at getting long in gold futures. I've talked about this. I think that gold is going to continue to show strength with the weakening dollar, because as soon as January comes around, they're even talking about a quick stimulus package here in 2020 ahead of 2021. So maybe a smaller package happening. That's going to weaken the dollar. That should even further, and that should give gold a little bit of strength. And we're just not seeing that today. So something to keep an eye on. Yes, it can stay irrational longer than we can stay solvent, but that's why we're going to wait for something like it to come down to the 200-day simple moving average. And a sell-off like that would be a catalyst for me to jump in. All right, bonds are coming off. Again, it tested its 50-day simple moving average. We've got the crossover, which is bearish when the 50 comes below the 200-day. That is more of a bearish sign here. So we are going to be fighting an uphill battle there in the bonds. But I do think that the market should be migrating back towards this point of control, because interest rates are not going to go anywhere anytime soon. Now, next week we get Beige Book, which is your first clue that, hey, the FOMC is just going to be around the corner about 2 weeks thereafter. So we've got another FOMC meeting coming up in about 3 weeks. So that is going to be something people will be keeping an eye on. I do believe that bonds should be migrating towards that point of control for the next few weeks. But today, it is not looking that good for it. All right, VIX is coming off, as you can see here with this chart. Excuse me. VIX is coming off today as we're starting to see the equities show a little bit of strength. As you can see with the Dow Jones Industrial Average up 150 points on the day, trying to get above that 9-day moving average, just coming up shy of it. We also have our old Fibonacci lined up here that I think that the market is going to want to breach and get above. That is going to act as a support and resistance, because that was where we were right before coronavirus hit. Now, is the economy as strong as it was before coronavirus? No, not really. Is the expectation that the economy will come out of this gangbusters after coronavirus? Yes, that's kind of the expectations here. We also got AstraZeneca coming out with their own vaccine, so that's 3. Now, they've had a bit of a mixed bag on the dosages and stuff like that. Believe it or not, if they got a half dosage and then a full dosage, their efficacy was about 90%. If they just got the dosages right off the bat, their efficacy was quite a bit lower. The nice thing about this one versus Pfizer is it can be stored in a refrigerator for several months, which is something that is key for a solid vaccine to really be something that we can use. The Pfizer one has to be kept super cold before it starts breaking down, and that is a bit of a problem to keep something that cold just anywhere, right? All right, so Dow Jones is moving higher. Now, the NASDAQ is coming off, but all of the tech things that I have in my account feel like they're a bit stronger here, but we are still seeing some of that rotation onto the opening up trade, right? Whereas the NASDAQ's going to have a lot of those tech-heavy stocks that have done very well throughout this pandemic, but now are probably going to see a little bit more weakness as people are looking for the reopening trade. And we've been talking about this for some weeks now. And we have the E-mini S&Ps slightly in positive territory, again, bumping up against some resistance here, as you can see. We are well above where we were before the pandemic in the E-mini S&Ps. But again, market is creating a higher high here with maybe a higher low, but that's kind of what we're seeing here with a move here. Got a bit of head and shoulders, really sloppy, but to me, the market feels like that reopening trade is in full swing. So let's take a look at the breakdown of the E-mini S&Ps on a 30-minute chart. And when you look at this, it's still that rubber band that's just winding up tighter and tighter. You can see we're getting a little bit jukey here as that rubber band feels like it's ready to unravel, but we've gone for a week and a half and might stay in a tight range heading into the holiday here in the United States for Thanksgiving. And then we have Black Friday, which comes the Friday after. Now, there's a lot of Black Friday sales online. As a matter of fact, some retailers are trying to incentivize people to shop online rather than go out there and do the doorbuster deals. The reason why is because of this coronavirus, right? So they're trying to incentivize some people. Plus, I think they're kind of looking forward and, hey, if we can get people accustomed to using our online platform, that will help us with our sales going forward. So they're trying to incentivize that right now. So I think we're going to see this tightening of the rubber band winding up for the rest of this week. Next week, we get some good economic data as well. I think we're going to, or some good news out of what's happening with the retailers. We could start seeing some moves to the positive side in equities. And if we start seeing this kind of fall on its face, we're going to watch the equities come off. And that's about it. I've got a lot of things going on today. I've got a whole new course that I'm going to be doing for some beginners, and you're going to need to check that out. If you've ever wondered, why an option does this, that, or the other thing, we're going to be breaking this down into layman's terms for the beginner trader. So if you're still a little bit fuzzy on this, we're going to start from building blocks and do a bit of a course for beginners there. So please check that out. As I'm going to be building those out. Keep your eyes out for it anyway. I haven't done it yet. I'm getting ready to do it this week and next week to get that ready for y'all. All right? So that's all I got for you. Other than one last thing we do always have to talk about is our disclaimer. We are an educational company. Please take a moment to go over this, as there are risks to trading. Okay? And you need to know those risks. If you can't take that, take it easy.